Hey guys, and welcome to another edition of Kip's Tips. Okay, in today's episode, I'm going to talk to you guys a little bit about mutual funds. So, what is a mutual fund? Well, I'm going to jump back here and I'm going to remind you, I just did my last video, which was index funds. Here's a little trick for you. Index funds are mutual funds. What? Yeah, index funds are mutual funds, guys. So this is something that I really actually struggled with in terms of figuring out what the difference between a mutual fund and an index fund. If any of you have ever dove into this topic in the past, maybe you kind of had the same thing that I had, where when I was trying to find this information, actually it's like something that nobody really explains super well. So I'm going to try to keep it as basic as I can and hopefully explain it well to you guys. But let me give it a shot. So you got mutual funds, which, like I told you in the last video, are these baskets. They are these baskets of these stocks for all these different companies. So what that does for you as just an average person, average investor, is it gives you the opportunity to basically buy up portfolios, very diverse portfolios of these baskets of stocks, just like these large companies are able to do in their portfolios, like millionaires are able to do, where they can get a bunch of shares of all the different companies and be really diverse. Well, with a small amount of money, with the average person's money, with these mutual funds, you can actually invest in some very diverse portfolios for yourself. And that's one of the greatest advantages of the mutual fund, is it really gives the average investor more of an opportunity to participate in something that is going to give them a safer return with less risk. And it's also kind of a reflection of the market. So now there are index funds and there are mutual funds, and I mean, technically these are all the same thing. Now, the big difference is, what are we talking about here? Are we talking about a passive mutual fund, or are we talking about an active mutual fund? So a passive mutual fund is actually what an index fund is. So the S&P 500, the triple Qs, the NASDAQ, things of that sort. They're very, very popular funds, actually, because like I said in my last video, I think that those are the best investment when it comes to choosing between an index fund or a mutual fund that's actually actively managed by professionals. So with the index fund, like I said, this is a passive fund, okay? Now, with the mutual fund, you could have an active mutual fund, actively trading. So what that means is you basically have a bunch of licensed professionals that are sitting behind computers all day, picking the trades for you. They're running your mutual fund with the main objective of beating the market. So a mutual fund is actively traded assets by a company that is doing that for you and trying to predict what's going to happen, basically track the market and beat the market and give you higher gains than an index fund, where an index fund just tracks the market, right? And it's passive, it's not being traded. So with an active fund, you're actually going to have a lot more trades, you're going to have a lot more fees, you're going to have more transactions. With a index fund, it's something that's just going to be passive. It's just going to be sitting there for you guys, growing over time. So one of the things that you got to point out about a mutual fund when you're talking about it is that you could potentially get more gains in a mutual fund, because you are trying to beat the market, and by beating the market you can potentially get a couple extra percent. I know that Dave Ramsey, a very avid YouTuber, I love his videos, by the way, he talks about mutual funds all the time and how much he loves them and how you should be involved in them. Now, he doesn't distinguish whether or not he's talking more about an active versus a passive. Maybe I got to dive deeper into some of his videos, but he stands by the concept of mutual funds overall. I think he likes more of an active fund, potentially. So I think there's a little more risk in that, but he claims that he found a really active, really good mutual fund that has a good history of getting 12-ish% gains year over year. And well, that's really great, because if you're doing an index fund, you should be getting, if the data is accurate over the last 100 years, you should be getting about a 10% gain year over year if you're looking at the last 100 years worth of data of index funds. So you could potentially get a better return on your investment in a mutual fund, but most of the time you don't. And that's one thing that I really need to point out, because you got people that are trying to game the system, they're trying to beat the market, and who's to say that those people make the right pick? If you got somebody actively managing your mutual fund, they could make the right pick, but if they don't, then you will underperform against the market. And you would have, in the end, been better off with an index fund, and you didn't really have to worry about are the trades that are happening right. You're just tracing the market at that point. So that's why I really do like the S&P 500. That's the one I talk about the most. The triple Qs are pretty neat. That's tech stocks. I mean, there's so many different funds that you could be looking into. But the way that you access these mutual funds and these index funds, you can go to different places like Vanguard, like Charles Schwab, like Fidelity, TD Ameritrade. There's so many different places that you can go to find these funds to begin your investing adventure. And each different spot that you go to will have different funds that are put together for you. So let's say you've got a 401k and you work for a company and you are currently investing your 401k. Let's say you're with Vanguard or whoever. I'm with Vanguard, and every time that, so when I'm putting my money in Vanguard, there are transactions that are happening in there, and each time a transaction happens, there's actually going to be a fee. Now, I'm getting charged these fees because they're managing this fund for me, whether they're managing it actively or passively. And if it's more active, then you'll have more fees. If it's passive, you'll have less fees. But regardless, I am actually getting charged fees. So they technically work for me, right? So I should be able to reach out to Vanguard and to get all the information that I need in regards to my fund. Make sure that you're tracking where your investments are and you know what your investments are allocated in. And if you could just contact the source of where you're actually putting your investment, and they should be able to tell you, because guys, you're paying for that. That's a service. They are taking fees from you. You have the right to that information. And it's just so good to know what you're investing in, basically. So, I'm going to leave it at that for today. I just wanted to lay out the difference between a mutual fund and an index fund, which again, a mutual fund is usually it is actively traded, and a index fund is passive. Okay. It's actually a passive mutual fund is what an index fund is. I like the index fund. You could make some great gains with some mutual funds. I don't want to make any recommendations on these because, to be honest, I'm not touching these. I'm sticking with the index fund. That's just me personally. Please leave some messages below. Tell me what mutual funds you like, what index funds you guys like. Maybe I could do a video on that, and I could dive a little bit deeper into those topics with you guys, and just keep expanding, keep finding more, keep exploring more topics, and keep bringing you another episode of Kip's Tips. Thanks, guys. Appreciate you stopping by.